If you have $500,000 sitting in a traditional IRA, you've probably been told your RMDs are manageable. The math checks out, the withdrawals are predictable, and maybe you've even built a rough tax plan around them. But the person who should really be worried isn't you. It's your 45-year-old daughter who inherits that account. Under the Secure Act's 10-year rule, she has to drain that IRA within a decade. If she's in her peak earning years, pulling in $150,000 a year in a state like California, she could lose more than $150,000 of your savings to federal and state income taxes. That's the tax bomb most retirees never see coming. Not because they didn't plan, because the advice they got only looked at one side of the equation. I used to think Roth conversions were only worth the effort for people with very large accounts. Then I ran the numbers for a client with a $600,000 IRA. His tax situation looked fine. Reasonable RMDs, comfortable bracket. But when I looked at what his kids would face, the picture changed completely. The biggest win from converting wasn't for him at all. It was for his children. In this video, I'll walk you through the exact math, how much your heirs could lose, and a straightforward Roth conversion approach that can turn that tax burden into a tax-free legacy. If you're a parent or grandparent with a traditional IRA and you want to protect your family from this hidden tax exposure, subscribe now. I'll show you the strategy to get ahead of it. Let's start with the numbers, because that's where this becomes real. Take a $500,000 traditional IRA inherited by a 45-year-old in California earning $150,000 a year. Under the Secure Act's 10-year rule, she has to withdraw the entire balance within a decade. At her combined marginal rate, roughly 24% federal plus 9.3% state, the average effective tax on those withdrawals works out to around 30%. That's $150,000 in taxes on your savings. The same $500,000 inherited as a Roth IRA, $0 in taxes. That gap is the whole story. Here's how the system works. A traditional IRA grows tax deferred. Every dollar goes in pre-tax, and the growth is sheltered until you start pulling money out. At age 73 or 75 if you were born in 1960 or later, the IRS requires you to start taking required minimum distributions. You pay ordinary income tax on each withdrawal. That's the deal you made when you took the deduction years ago. So far, nothing surprising. The problem starts the moment the account passes to your kids. Before 2020, a non-spouse heir could spread those withdrawals over their own life expectancy, sometimes 30 or 40 years. The taxes were spread out, the amounts were manageable, and the account kept growing. That strategy had a name, the Stretch IRA. The Secure Act eliminated it for most non-spouse beneficiaries, effective for deaths after December 31st, 2019. Now, most non-spouse heirs have 10 years, that's it, and the timing is almost never in their favor. If you're 68 right now and your heir is 40, they'll likely inherit that account somewhere in their mid-50s, exactly when their salary is highest, their deductions are lowest, and an extra $50,000 a year in forced withdrawal stacks on top of everything else they're already earning. A forced distribution from an inherited IRA is just regular income to the IRS. It doesn't matter that it came from an inheritance. In high-tax states, the combined marginal rate on those withdrawals can hit 37% or higher. On a $500,000 account, that's a tax bill that could approach $150,000 or more, depending on their income and timing. That's not a rounding error. That's a meaningful portion of everything you built. This isn't about the system trying to punish your family. The IRS and state tax authorities designed the 10-year rule to accelerate the collection of taxes that were always going to be owed. The question has never been whether this money gets taxed. It's always been about who pays, You at a rate you can control right now, or your kids at a rate you can't predict and probably can't influence. Most retirees focus almost entirely on their own RMD burden and never look at what the next generation faces. The advice gets narrower when it should be getting wider, and that's exactly where the trap is. Once you understand the exposure, the next question is whether a Roth conversion actually makes sense for your situation. Not every family is in the same position. So rather than a one-size-fits-all answer, I want to walk you through a 3-question decision tree I call the Legacy Tax Shield. First question, will your heirs be in a higher tax bracket than you are right now? If your current marginal rate is 22% and your son or daughter is a physician, an attorney, or a software engineer earning $180,000 or more, the spread between your rate and theirs is the conversion opportunity. Every dollar you convert at 22% is a dollar they don't have to withdraw at 32%, 35%, or more. Second question, do they live in a high income tax state? Federal tax is only part of the story. A California resident in the 32% federal bracket adds 9.3% state tax on top. A New York City resident adds more. If your heirs live in a state with no income tax, like Texas, Florida, or Nevada, the federal math alone still applies, but the combined exposure is lower. State residency changes the numbers significantly. Third question, do you have charitable intent? If you plan to leave a portion of your IRA to a charity or a donor-advised fund, you may be better off directing traditional IRA dollars there and converting the rest to Roth for your family. Charities pay no income tax on inherited IRAs, so the 10-year clock doesn't cost them anything. I remember sitting with a client named Dave. He had $700,000 in his IRA, owned his home outright, and his daughter was a doctor in San Francisco. When I showed him what her tax bill would look like, roughly $180,000 on the inherited balance at her marginal rate, he didn't hesitate. He said, "I'd rather pay the tax myself right now." That moment shifted the way I approached this conversation with every client over 60. Here's a quick example of the framework in practice. A couple, both 68, with $800,000 in a traditional IRA, a $30,000 pension, and Social Security delayed to 70. Their current marginal federal rate is 22%. Their heirs are in the 32% federal bracket plus 9.3% California state tax. They live in Texas, 0 state income tax. Converting $50,000 per year for 5 years at 22%, federal costs them around $55,000 in total conversion tax. But it removes roughly $150,000 or more in tax exposure from their heirs' side of the ledger. That's not a perfect trade, but for families with this gap, it's a meaningful one. If that sounds like it might apply to you, the next section shows you the actual historical shift that made this math so important. This wasn't always the situation. Before 2020, a non-spouse heir could stretch inherited IRA withdrawals over their own life expectancy. If a 40-year-old inherited a $500,000 IRA from a parent, they could take small distributions over 40-plus years. The taxes were spread out over decades. The amounts were modest year to year, and the remaining balance kept growing. It was one of the most powerful tax planning tools families had. The Secure Act, which took effect January 1, 2020, replaced that with the 10-year rule for most non-spouse beneficiaries. Congress needed the revenue, and the stretch IRA was considered a loophole that mostly benefited higher-income families. Regardless of the reasoning, the practical effect was dramatic. A strategy that made inherited IRAs almost infinitely flexible was replaced with a hard deadline. Now layer in the actuarial reality. According to the Social Security Administration's 2025 Period Life Table, a 65-year-old man has a life expectancy of about 18.2 more years, to around age 83. A 65-year-old woman can expect roughly 8 more years to about age 86. That means most retirees will take RMDs for somewhere between 10 and 15 years before the account passes to heirs. Think about what that means in sequence. You spend a decade or more drawing down the account, paying ordinary income tax along the way. Then your heir inherits what remains and has 10 years to drain whatever is left during their own peak earning window. 2 back-to-back tax clocks, both running on ordinary income rates. The total tax exposure over the full timeline is something most financial plans never actually model. That's the gap. And the next section shows you what it costs in a real-world scenario. Let's run 2 paths side by side so you can see the actual dollar difference. Start with a 68-year-old retiree in Florida with a $600,000 traditional IRA, a $25,000 pension, and Social Security starting at 70 at around $30,000 per year. One heir, a 45-year-old daughter in California, earning $160,000 per year. Path 1, do nothing. RMDs kick in at age 73. The first required distribution on a $600,000 balance is roughly $22,800 based on the IRS Uniform Lifetime Table. Add that to the pension and Social Security, and the combined income pushes comfortably into the 22% federal bracket. Manageable. The retiree lives to 85. After 12 years of RMDs and modest account growth, the IRA balance at death is around $400,000. The daughter inherits that amount. She has 10 years to drain it. At her combined rate, 32% federal plus 9.3% California state tax. The effective tax on withdrawals averages around 41%. Total tax, roughly $165,000. Her net inheritance, about $235,000. Path 2, partial Roth conversions. The same retiree starts converting $30,000 per year from ages 68 through 72, 5 years before RMDs begin. She lives in Florida, so there's no state income tax. She pays the conversion tax from a separate taxable savings account at her current 22% federal rate. That's about $6,600 per year, or $33,000 over 5 years. At death, the account has split, roughly $300,000 remaining in the traditional IRA and $200,000 in the Roth. The daughter inherits both. The traditional portion still triggers taxes, about $124,000 at her combined rate. The Roth portion is completely tax-free. Net inheritance, about $376,000. The difference between those 2 paths is $141,000. For context, according to Fidelity's first quarter 2026 data, the average IRA and 401k balance for households between ages 55 and 64 is approximately $537,000. So this isn't a scenario reserved for the very wealthy. A lot of families in that average range are sitting on exactly this kind of potential exposure without realizing it. You still have choices. The earlier you start converting, the more control you have over who pays the tax and at what rate. But I know what the hesitation sounds like. You don't want to pay taxes voluntarily. What if something changes? What if you need that money? That's worth addressing directly. Paying tax today feels like a loss. Your brain genuinely processes $10,000 in conversion tax as more painful than $30,000 in future taxes your kids will pay. That's present bias, a completely normal cognitive pattern where immediate costs feel larger than distant ones, even when the distant cost is objectively greater. Knowing the name doesn't make it go away, but it helps to recognize what's driving the hesitation. I don't think you should dismiss that hesitation. If your health is uncertain, or if you genuinely expect your income to drop significantly in the next few years, the math might favor waiting or doing nothing. Roth conversions aren't right for every situation. The strategy works best when the rate you pay now is meaningfully lower than the rate your heirs will face. If that gap doesn't exist, neither does the benefit. But for many people, the hesitation isn't really about the math. It's about writing a check to the IRS before you have to. One way to reframe it, think of conversion tax as an insurance premium. You're paying a known amount today to protect your heirs from an unknown, likely larger bill later. You wouldn't cancel your homeowner's insurance because your house hasn't burned down yet. The risk is real whether or not it has already materialized. I'll be honest, I've had clients who converted a portion of their IRA, then watched the market drop the following year. The conversion looked worse in hindsight, at least temporarily. That discomfort is real. Roth conversions aren't a perfect strategy, but in the cases where heirs are facing a genuine tax gap, the long-term regret of not converting tends to outlast the short-term regret of converting at the wrong moment. So how do you actually do this without making a costly mistake? There are 3 concrete steps worth knowing. Here are 3 concrete things you can do this year if you think Roth conversions might make sense for your family. Step 1. Calculate your heir tax gap. Start with your current IRA balance. Apply a conservative growth rate, say 5% per year, out to your estimated life expectancy. That gives you a rough balance at death. Then estimate your heirs' combined marginal tax rate, federal plus state. Multiply the projected balance by that rate, and you have a rough tax bomb number. If your IRA is $500,000 today, and your heir is in the 32% federal bracket plus state tax, the combined exposure could easily exceed $150,000. That number gives you a baseline to work with. Step 2. Use bracket filling conversions. The idea is simple. Convert just enough each year to fill your current tax bracket without pushing into the next one. For 2026, the 22% bracket for married filing jointly runs from $100,800 up to $211,400 in taxable income. If your pension, Social Security, and other income leaves room inside that bracket, you can convert up to that ceiling and pay 22% on those dollars. That's likely a lower rate than your heirs will face. You don't have to convert everything. Even $20,000 to $40,000 per year, done consistently in the years before RMDs start, can meaningfully reduce the inherited balance. Step 3. Watch the IRMAA threshold. Medicare Part B and Part D premiums are income tested, and they use a 2-year look-back. A large Roth conversion in 2026 affects your 2028 Medicare premiums. For 2026, the income threshold where IRMAA kicks in is $109,000 for a single filer and $218,000 for a married couple, filing jointly. Convert past that line and you'll pay a Medicare surcharge 2 years later. That doesn't mean you shouldn't convert. It just means the cost of conversion is slightly higher than the income tax alone. Factor it in. One more option worth mentioning, especially if you have charitable goals: Qualified Charitable Distributions. Starting at age 70 and a half, you can direct up to $108,000 per year directly from your IRA to a qualifying charity. That money counts towards your RMD, never hits your taxable income, and permanently reduces the balance your heirs will eventually inherit. For families with both charitable intent and a large IRA, combining QCDs with partial Roth conversions can address both sides of the problem at once. If you want to walk through all of this step by step, subscribe and hit the bell. I'll be covering the implementation details in an upcoming video. The decision between sticking with your traditional IRA and converting to Roth isn't just about your own tax bill. It's about who ends up paying and when. If your heirs are in a higher bracket than you are, live in a high tax state, and will inherit during their peak earning years, the math almost always favors acting before RMDs begin. The legacy tax shield comes down to 3 questions. Is your heir's tax rate meaningfully higher than yours? Do they live in a high income tax state? And do you have charitable intent that could redirect some of those IRA dollars more efficiently? Work through those questions honestly, and you'll have a clearer sense of how much conversion makes sense for your family. You've spent decades building this account. The tax code is going to take its share one way or another. That part isn't negotiable. What you can control is the timing, the rate, and who writes the check. A thoughtful conversion strategy doesn't eliminate the tax. It moves it to where it costs your family the least. If you're a parent or grandparent with a traditional IRA and you want to protect what you've built, subscribe now. I'll keep showing you how to think through these decisions clearly. Thanks for watching.